Welcome back, everyone. Today we're diving into one of the most important questions hanging over the global economy right now. Is the Federal Reserve preparing to slash interest rates more aggressively this year, or is it about to slam the brakes on those expectations? Because this week the Fed, and specifically Jerome Powell, its chair, just sent a message. And it was not the one investors, Wall Street, or even policymakers in Washington were hoping to hear. So, let's break it all down. What Powell really said, what it means for your job, your mortgage, your car payments, and your future, and why the internal fight inside the Fed is becoming just as political as it is economic. Stay with me, because by the end of this, you're going to see why the Federal Reserve's next move could change everything. Jerome Powell stood before an audience in Providence, Rhode Island, and delivered remarks that were both calm and chilling. He admitted what many already suspected. Yes, interest rate cuts are coming, but don't expect them too soon. Now, that's a problem for politicians, Wall Street bankers, and even the average household trying to figure out whether the pain of high borrowing costs will ever end. Why? Because Powell's tone wasn't optimistic, it was careful, it was cautious. It was a message that the Fed is terrified of making the wrong move. And here's why. Inflation is still stubborn. Even though it's off the highs of 2022, it remains above the Fed's so-called 2% target. And it's been ticking upward again in recent months. The labor market is softening, unemployment is creeping up, job openings are narrowing, and wage growth is slowing. That combination is dangerous. Economists call it the nightmare scenario, inflation that won't die, but jobs that are disappearing. If the Fed miscalculates here, it could set off a recession, or worse, stagflation. Let's step back for a second. The Fed has two main goals, what's called the dual mandate, maximum employment, stable prices. Sounds simple, right? In reality, it's a brutal balancing act. Lower rates too quickly, and inflation comes roaring back. Keep them too high for too long, and the job market collapses. Just last week, the Fed made its first rate cut of the year, a modest 25 basis points. A small step meant to relieve some pressure on households and businesses. But Powell's words during that announcement stunned many. He admitted that the Fed was finding it challenging to know what to do. Think about that. The chair of the Federal Reserve, the single most powerful economic voice in the world, admitting uncertainty. That tells you just how fragile this moment is. Fast forward to this week, and Powell doubled down on caution. His warning, if we cut too aggressively, we could leave the inflation fight unfinished, and then we'd be forced to raise rates all over again. Translation? A fast cut could backfire, forcing the Fed to reverse course, hammering the economy twice. But here's the twist. Not everyone at the Fed agrees with him. Stephen Miron, a Fed official appointed by Trump, came out swinging this week. His proposal? Slash rates aggressively, take them down to 2.5%. That would almost cut rates in half compared to today's level. Why? Because Miron believes inflation is calming, the labor market is weakening, and delaying action risks turning small cracks into massive fractures. And he's not alone. Michelle Bowman, another Fed governor, also pushed for faster cuts. Their argument is simple. The cost of waiting is greater than the cost of moving too fast. This is no longer just a technical debate, it's becoming a political showdown. On one side you have Powell and his allies like Chicago Fed President Austin Goolsbee, warning, be careful, inflation hasn't disappeared. Aggressive cuts could reignite the fire. On the other you have Myron Bowman and a growing chorus of officials saying, the economy is stalling, high rates are doing more harm than good, if we don't act, recession will hit. This split exposes the Fed's deepest dilemma, because let's face it, rate cuts aren't just numbers on a chart. They ripple into every part of daily life. Mortgages, lower rates make home loans cheaper, car payments, financing drops, buyers spend more, credit cards, borrowing costs fall, households breathe easier, businesses, investment rises, jobs expand, at least in theory. But the reverse is also true. If Powell cuts too aggressively, inflation can roar back, and ordinary families will pay for it in higher grocery bills, rent, and gas prices. Here's where it gets even more interesting. This isn't just economics, it's politics. Donald Trump has made no secret that he wants lower interest rates to juice the economy heading into election season. Officials like Myron are closely aligned with that agenda. Powell, meanwhile, is trying to project independence, but make no mistake, every Fed decision will be interpreted through the political lens, and that creates a dangerous dynamic. If the Fed cuts too slowly, Trump will hammer Powell as sabotaging the economy. If the Fed cuts too quickly and inflation spikes, Powell will be blamed for failure. Either way, the Fed chair is walking a political minefield. So, what's the outlook? Right now, the Fed has signaled the possibility of 2 more rate cuts this year. But Powell's tone makes it clear, these cuts are not guaranteed. They'll only happen if the data shows inflation is cooling and the labor market is deteriorating further. That means every jobs report, every inflation release, every consumer spending number will be watched like a hawk. One hot inflation print, and those cuts could vanish. One ugly jobs report, and the Fed may be forced to accelerate. It's an economy living on the edge of uncertainty. Now I know what you're thinking. This is all Fed speak. Why does it matter to me? Here's why. If Powell stays cautious, your mortgage and credit card rates stay high longer. If the Fed caves to pressure and cuts aggressively, you might enjoy short-term relief, but risk higher prices later. If the Fed miscalculates entirely, we could end up with recession or stagflation, both devastating for households. This isn't just theory, it's about whether families can afford homes, whether businesses hire or fire, whether inflation eats away at your paycheck. In many ways, Powell's entire legacy is on the line. He doesn't want to go down in history as the Fed chair who declared victory over inflation too soon. Think back to the 1970s. The Fed cut rates prematurely, inflation reignited, and it took years of pain to crush it again. Powell has studied that era closely. He doesn't want to repeat it. But the risk? If he moves too slowly, millions of workers could lose jobs unnecessarily. It's the ultimate no-win situation. So where does that leave us? Here's the bottom line. Powell is in no rush. He's signaling caution, even if that frustrates Wall Street, the White House, and struggling households. Will that caution save the economy, or doom it to stagnation? That's the trillion-dollar question. And now I want to hear from you. Do you think the Fed should cut aggressively now to save jobs? Or should Powell hold firm to crush inflation once and for all? Drop your thoughts in the comments. I read every single one. And if you found this breakdown valuable, please smash that like button, subscribe to the channel, and share this video so more people can join this conversation. This story isn't going away. The Fed's next move could reshape the economy for years to come. Stay tuned, because I'll be covering every twist and turn right here. Thanks for watching, and I'll see you in the next video.